In this video, we're going to look at recent trends in inflation. We're going to look at the case for and against higher inflation going forward, and then also glimpse at asset class performance during higher inflation periods. But let's just first start with a bit of a look at recent trends in inflation. And first chart I just wanted to highlight was the US CPI over the last few months. We've seen numbers in the vicinity of 0.4, 0.6 and 0.6 in fact, so three quite strong lifts in inflation. But the way we're viewing that is that largely reverses some of the big declines that we saw. In fact, the annual rates now have risen after being above 2%. This is the core CPI falling close to 1%, have now moved back to 1.5%. So we see these latest numbers as more of a reflection of a bounce back from very weak price levels. And I think we can back that up when we look at the trimmed mean. This is the Dallas Fed, the trimmed inflation measures, and they strip out the high and lows, the extreme numbers within the basket of goods being measured. And to all extent and purposes, this is still sitting around about the 1.5% level that we've seen over a period of time. Is there any sign of inflation creeping up in other areas? Possibly one area where we do see price rises is in some commodity areas, but once again, it's certainly in the case of copper, prices have been rising. Often copper is seen as a barometer of growth. It has been rising and it's up some 30-35% from the March lows. But again, in the overall scheme of things, not pointing to inflation. Neither would we say is iron ore at the moment. Now, gold perhaps is where it does get interesting, but we suspect this has got more to do with negative real yields rather than rising inflation expectations. So if we just have a look at this one very quickly, this just goes back, looks at the relationship between gold in today's dollars, so up around about the 1900 to 2000 an ounce area. That's the left-hand scale, and the right-hand scale inverted is the real 2-year bond yield. So we feel that the decline in real yields is more of the driver of gold price than would be inflation or higher inflation or higher inflation expectations at this point. So at this point, the evidence is, we don't think is there. Yes, there's been of an uptick, but it's more from a very weak level. And likewise, if we look at the implied inflation numbers, we can tell a similar story. Now, I'm going to first look at the US numbers, and there's been a lot of talk around rising inflation expectations in the bond markets. And what we see in the case of the US, this is I'll look at the 5-year implied inflation number. That's moved, that's the red line, that's moved from close enough to zero during March up to about 1.5%. So that's a very substantial and quite a sharp lift in implied inflation expectations. But really all it's done is taken it back to roughly where it's been over the past 5 or 6 years. So we don't feel that that's suggesting anything more sinister on the inflation side at this point. And in Australia, even more so, what we find is that implied inflation at the 5-year part of the curve had sort of got down to actually hit very, very briefly negative levels, but let's call it zero. It's risen up to about 0.9%, so still quite low, particularly when you compare it to the US. So Australian investors implying some pessimism still on prices going forward, as I said, with the break even sitting at 0.9. So the way we'd sum up that would be that yes, inflation expectations have risen, but more from very low levels rather than suggesting a breakout to much higher levels than experienced in recent times. Another survey, this is a survey of professional forecasters in the US, that suggests a 90% probability of the US inflation rate being less than 2% over the next year. And in fact, if we go out to the following year, it's still high, it's about 70%. So by and large, most forecasters are still expecting inflation to be sub 2% in the US. So that's not exactly a high inflation environment. Back in March, there was a 26% probability of the CPI being above 2.4%. That now has fallen to about 3%. This is over the next the next 12 months, and then deflation risk probability was seen at 7% in September, up from 0. So, following from the lockdowns, COVID-related lockdowns, and the recession that started earlier in the year, inflation projections have actually come down. But having said that, they do expect inflation to pick up in the following year, so the subsequent, if you like, in year 2. But nevertheless, low inflation is still um, uh, the uh, the mainstream forecast at this point. So where does this whole debate around inflation sit? Where is the concern over the risk of inflation arising from? And I think we have to look at the policy bias now that seems to be in place, and I guess the combination of both very extreme monetary and fiscal policy settings. So I want to first consider the central banks, and we'll focus in on the Fed because they're the ones, obviously a significant central bank, but the ones who have made a change to their framework to explicitly tolerate periods of higher inflation than they have in the past. So if we look at the rule of thumb, or I guess the framework that's been adopted historically, has been around output gaps, and this can be represented by looking at the unemployment rate relative to NAIRU. That's the blue line. So if the blue line's up high, it means there's a lot of excess labour in the market. So a weak economy. So as the economy strengthens, as NAIRU falls closer, as unemployment, falls closer to the full employment level, capacity is being used up. The Fed has historically been tightening in those periods in a preemptive fashion. The shaded areas are periods of Fed tightening. So preemptive there. A bit late, I'll come to that shortly, certainly in 2005 through to 6 and again on this occasion. So they've always tended to act as the economy approaches full capacity. What they've said now is that given the difficulty in getting inflation up over the last 10 or so years, inflation has underwhelmed its objective of 2%. They are going to let the economy grow for longer. We suspect perhaps that implies through full employment. So there's no chance of monetary policy being tightened anytime soon. So allowing the economy to run hotter for longer, I suppose, with more of a focus on employment as opposed to the deviation from full employment. So that's certainly a change in policy settings, allowing or becoming more tolerant towards inflation being above the 2% level to make up for periods when it's been below. So that is probably one of the factors at the core of the concerns, or at least the debate around the possibility of higher inflation. Another way of perhaps looking at this is to say that the massive increase in debt to GDP ratios that have resulted over the last 10 to 12 years, but also more specifically since COVID, means that governments are in a situation where they've put in place some significant fiscal easing, but debt to GDP ratios have all pushed up quite a lot higher than where they were. In the US, we're sitting at about 100%. Many European countries are around about 100%. Japan, in net debt terms, sitting at 170%. So the concern is that with debt levels so high, at some point, governments are going to have to tighten fiscal policy. Well, the other part of the argument is, well, perhaps they don't need to tighten quite as much as one might think, and that's based on the observation that bond yields at present across most major economies are trading below nominal GDP growth. And to the extent that they are below nominal GDP growth, it means the tightening on the fiscal policy side does not need to be as much, and indeed debt to GDP ratios can stabilise or have a greater chance of being stabilised in this sort of situation. So in the case of the US, 0.7% is the 10-year bond yield, nominal GDP growth something like 3%. So you can see there that actually assists in stabilising government debt to GDP ratios. Now that can be achieved by a couple of things: trying to grow the economy a bit faster, trying to add to inflation, and perhaps even also keeping bond yields low. So these are the sources we think of the focus on higher inflation risks going forward. And another way of looking at that is to look at the money supply growth numbers. Money supply in the OECD at the narrow money, that is M1, growing by about 25%. And that has been pointed out as a potential risk for inflation going forward. The problem is that those cash balances or that extra money supply growth is finding its way into cash balances, precautionary perhaps, corporates, household sectors sitting on lots more cash than they have in the past. So it's not circulating in the economy and not creating final demand that may in fact push up prices. Another area of debate is, of course, around wages, and I just want to focus in on this one chart here, which looks at the relationship between wages and unemployment relative to NAIRU, so the old Phillips curve relationship, which has basically been tossed out essentially as a monetary policy rule for now at least. And having said that, one would think, and an argument against higher inflation would be that with all the slack that is in the labour market at the moment, that is, unemployment is well above full employment, that's a very difficult environment within where, in which wages would grow to any extent. And so that removes a source of inflation threat. And you can see the relationship here between the Atlanta Fed wage tracker, which is higher wages growth up there, and this is tight labour market, and this is a very slack labour market, and that's what we're in at the moment. So it's hard to envisage a lot of wages pressure in the current situation. Another area of discussion around the inflation argument or the risk of higher inflation going forward, it comes on two fronts. One is looking at the prospect of what they call deglobalization, and throw into that changing supply chains, exacerbated by the COVID crisis. So just for a bit of history first, from 1990 through to about 2008, global trade growth far outpaced global output growth. And so this is, if you like, one proxy of globalization. So trade become increasingly important throughout the world, and that's predominantly the rise of China coming through during this period. So a massive increase in trade relative to growth. Over that same period, the red line shows that this is OECD CPI, declined from about 6% down to about 2% over that same period. Since 2008, though, the growth of trade has slowed quite a bit, and it now is basically just keeping pace with global output growth. So trade saturation, I suppose, has fallen back. China's become less reliant on exports for sources of growth, and more recently, other issues around protectionism and so on are leading to sort of calls for deglobalization or the reversal of this trend, and thereby using that as an argument for higher prices going forward. To this point, we just see this flattening out. To us, it doesn't seem to be suggesting that we're going to see a reversal, but we're certainly not seeing the impetus to lower inflation, given that this is occurring. And then one other comment, just in terms of trade and import prices, US dollar is a key component of what happens to prices, certainly in the US, but also globally. This is the US dollar. So during 2009 to about 2012, the US dollar weakened. Over that period, US import prices rose. Generally, these are all the different categories of import prices we're looking at. But since, let's say, since probably 2014-15, we saw a considerable strengthening in the US dollar. And it's no surprise that import prices, no matter which bucket you look at, have been on a declining trend ever since. So the argument would be that if the US dollar is indeed at the beginning of a bear market, then that will add to import prices and add to the overall price level more generally. So they're just some of the components, I suppose, of the debate around inflation. At this point, the evidence is very limited for higher inflation. The expectations are not really there for higher inflation. The policy bias does suggest that there is a risk of inflation, but there are a number of other factors that suggest in the near term prices are likely to remain quite weak. I just want to finish up now with just a little bit of a focus on asset class performance in different during inflation periods. And the first one, just want to highlight again, we've seen this relationship before. This is the US valuation using a CAPE or a Shiller PE, and that's on the Y scale. The X scale is the annual inflation rate. And essentially what we're trying to show here is that the valuation on the US equity market can be anything pretty much as long as inflation's been between 0 and 4. It's really only once it moves outside those ranges, so deflation from where the cursor is or above 4% is where PEs have contracted quite significantly. And so it does appear to be a relationship there, but certainly not as long as inflation's in that sort of 0 to 4, probably more generally, or maybe the 1 to 3% range. Valuations can be pretty much supported where they are. So if we just look, I'm going to finish up with just focusing on some actual asset class performance during rising inflation periods. So we've chosen regimes of rising US inflation since the 1970s, and what we're looking at is how various asset classes have performed. So the S&P 500, it's been mixed. You can see here on two occasions, that would be 2000 and then 1973. They were associated with recessions. The equity market fell away, but on all the other occasions, or the other four occasions, equity markets actually rose. And in real terms, we see a similar but less positive story. So it's a modest rise in the US equity market. So the evidence there is probably somewhat mixed for the performance. If we look at focus in on, say, the US 10-year bond yield itself, and I think this will show, and we're just going to look at that in basis point terms. So bond yields, this is what's happened in bond yields in rising inflation periods since 1970s. As one might expect, generally a rising trend outside of 2000. So, rising on average by about 150 basis points over a 18-month period. So that in today's market, with bond yields starting at 0.7%, a 150 basis point sell-off amounts to about a 12% loss from US bond holdings. So a significant loss would occur there. What about the index bond, the inflation-linked bond? How has that performed? Well, this is interesting. The market hasn't been around that long, so it only captures 2000, 2004 rising inflation periods. But in fact, what we saw in the first 6 to 12 months for inflation-linked bonds is that the yield actually declined. So you can see there that they have put in a reasonable performance, but the sample set is quite small. So inflation-linked bonds look to have performed reasonably well. Obviously, gold is another asset class that one might expect to do reasonably well in rising inflation periods, and that broadly seems to be the case, with the exception of the sort of mid to or late 80s, where it was predominantly flat. But gold, by and large, has performed pretty well, particularly in the earlier 70s periods, the rapidly rising inflation periods. And then one other area of interest, I think, is the growth versus value area. And what we find here is growth versus value at a global level. Growth has tended to underperform during these rising inflation periods. Not by a lot, or it did in 2000, but sort of a slight underperformance in those other periods. Now, I'm just going to finish up with looking at Australian inflation periods. So far we've been using US inflation. I just want to use the periods of rising Australian inflation. So we've got, they're slightly different. So I just want to look at Australian equities, which we'll do now. And again, as it was in the case of the US, quite mixed, three very positive periods and three quite negative periods. The three negative periods were 73, that is 94, and the other one is 81. So it's quite a mixed outcome for equities, but more often associated with, was there a recession associated with it, with the rise in inflation? That is, was policy tightened significantly to combat rising inflation? So our take on that would be, as long as central banks, if they are willing to sort of sit back and not respond to a slight lift in inflation, then equity markets can perform reasonably well in that environment. Just going to finish up with the 10-year bond yield. What's happened to the 10-year bond yield? We can see that the basis point rise, these are basis points here, so that's an average of about 150 again over a 12-month period. There was one occasion where it would actually decline. So broadly higher. For the index bond, this is the index bond. So we only again have these two periods that we're looking at, which is basically 94 and 05. And index bond yields did rise, but not nearly as much. You can see them rising 180 basis points and 40 basis points in 94 and 05. If we looked at the Aussie 10-year for those two periods, I'm going to remove all the others just so that we can make comparison. As I said, 340 basis points and 100 basis points. So the index bond lead market, although it does have a longer duration, that was not sufficient to lead it to underperform nominal bonds. So there does seem to be a role to play. And then if just a couple of other asset classes we'll finish up with, direct property. Again, the performance of that asset class has been quite strong during rising inflation periods. And the other area, if we look at sort of unlisted infrastructure, we only have one period there, so we won't spend any more time on that. So that's how we see it. I think to sum up, the way we view the inflation situation at the moment is it's to remain low in the near term. We do think that the policy bias is heavily weighted towards creating inflation. We do see it as an issue, but we see it more as a strong likelihood that inflation pushes up into the 2 to 3% range, which is not necessarily negative for equities generally. Historically, it hasn't been at that level, but it would tend to be a damaging environment for bond yields if bond yields are indeed permitted to sell off in response. So we'll leave it there, and thank you very much for listening. Thank you.